Are you over 40? Have you been the responsible one, diligently saving cash in the bank your whole life? But lately, does it feel like no matter how much you save, your money buys less than it used to? You aren't crazy, that's the inflation monster eating your hard-earned cash. You know you need your money to grow, not shrink. You're thinking about the stock market, but it feels scary. Welcome to the club. Today, we are going to move from scared saver to informed investor, step by step. Before we start, we need real talk. The bank is safe, your capital is guaranteed, but as you've noticed, the returns are tiny and inflation is beating you. Investing in the stock market wakes your money up, but it comes with risk. Unlike the bank, there are no guarantees. The market has ups and downs. You can see your account value drop temporarily. The risk of losing money is real in the short term. But historically, for patient, disciplined investors who stay on the ride for the long term, the rewards have been much, much higher than cash. So, what is the stock market? It's just a place where people buy and sell tiny slices of ownership in companies. These slices are called shares. When you buy a share, you become a part owner. If that company sells more products and grows its profits over a year, your slice becomes more valuable. Your $50 slice is now worth $55. That $5 growth is your profit, a 10% gain. But picking the winning company is hard. What if you pick the wrong pizza? That's why, for most beginners, we don't buy single slices. We buy the whole pizzeria. This is an index fund. Instead of betting on one company, you buy a tiny piece of the entire market. You are betting on the global economy growing over time. How much will you make? No one knows for sure. The ride won't be smooth. Some years the market drops. But historically, major index funds like the US S&P 500 have averaged over 10% growth per year over decades. Before you invest, ask yourself, why? Your goal defines your strategy. Investing is a long game. This is the golden rule: never invest money you need in the next 3 to 5 years. The market could crash just when you need to withdraw cash. Only invest what you can leave untouched for the long haul. Wait, before you buy your first fund, your financial foundation must be solid. Do you have 3 to 6 months of emergency cash in the bank? Have you paid off expensive credit card debt? If yes, you are ready to build wealth. Here is your beginner's checklist to get started safely. Educate yourself. You're doing that right now. A share is exactly what it sounds like, a share in the ownership of a company. When you buy a share of a business like Apple or Amazon, you become a co-owner. If the company grows and makes a profit, your share of that company becomes more valuable. Think of the stock market as a global digital auction house. It's a place where investors meet to buy and sell ownership in companies. Prices change every second based on supply and demand. If people believe a company has a bright future, they buy, and the price goes up. If they lose confidence, they sell, and the price goes down. Instead of trying to guess which single stock will win, an index fund lets you buy a bundle of the world's top companies all at once. For example, an S&P 500 fund gives you a tiny piece of the 500 largest companies in the US. It's a diversified, low-risk way to grow your wealth without needing to be a pro trader. Every fund has a cost to run it. The expense ratio is the annual fee you pay the fund manager to handle the paperwork and trades. It's a percentage of your total investment. Even a small difference, like 0.1% versus 1.0%, can cost you tens of thousands of dollars over time. Always look for low-cost funds to keep more of your returns. Buy stocks or funds, you need a broker or a digital platform. The platform fee is what they charge you for using their technology and keeping your investments safe. Some charge a flat monthly rate, others take a small percentage of your portfolio. Think of it as the service fee for your investment account. Step 2. Choose a platform. Find a reputable, low-cost online broker available in your country. Look for low fees. You've educated yourself on the basics. Now, you need the tools to act. Choosing a brokerage platform is like choosing the vehicle for your financial journey. Pick the wrong one, and high fees or poor security could stall your progress before you even begin. Before you open a standard account, stop. Most governments want you to save for the long term and offer special tax-advantaged accounts. In the UK, this might be an ISA, in the US, an IRA. The names change globally, but the goal is the same, keeping more of your returns shielded from taxes. Fees are the silent enemy of compounding interest. You need to scrutinize 3 main costs. First, the platform fee. Are they charging you just to hold your investments? Second, trading fees. How much does it cost every time you buy or sell? And third, for international investors, foreign exchange fees. Look closely at the markup when buying assets priced in another currency. Keep these as low as possible. Ensure the platform gives you access to the global markets you need to build a diversified portfolio. Does it offer low-cost index funds that track major world indices, like the US S&P 500? Does it provide the necessary research tools and charts you need to make informed decisions? Finally, never compromise on security. Verify that the platform is authorized and regulated by your country's top financial authority. Confirm that a government compensation scheme protects your assets if the brokerage goes bankrupt. And practically, make sure the app is intuitive. You want a user experience that makes managing your future clear, not confusing. Step 3. Keep it simple. Don't try to complicate. A low-cost S&P 500 and a globally diversified index funds are a great starting point for many. Step 4. Start small. You don't have to move your life savings at once. Start with an amount that doesn't make you nervous, just to learn the ropes. Step 5. Automate it. Set up a monthly transfer and forget about it. This removes the stress of trying to time the market and builds discipline. Moving from saving to investing in your 40s is a big step, but it's necessary to protect your future purchasing power. Be patient, stay disciplined, ignore the short-term noise, and let time and compounding grow your wealth. You've got this. If you found this useful, please do hit the like button and subscribe for more.